Welcome to the deep dive. Today, we're zeroing in on Canadian Natural Resources, CNQ. We'll be unpacking their Q3 2025 results and, their big strategic plays.
Yeah, and we're digging into their latest earnings call and the press release they put out. Lots to cover.
Right. And our mission really is to figure out this central puzzle from the quarter. How did CNQ hit these massive record production numbers up 19% year over year, which is huge,
Huge numbers, yeah.
but keep their operating capital budget for the year totally flat, locked in at about $5.9 billion?
It sounds counterintuitive, doesn't it? More volume usually means more spending.
Exactly. It feels like it shouldn't work mathematically. So the big question we're chasing is, what levers did they actually pull? What specific things did they do to get that production lift without just throwing more money at it? Okay, let's dive into those records first.
Well, the scale of it is pretty staggering. It really cements their place as a heavyweight. Total corporate production was around 1.62 million barrels of oil equivalent per day.
EOEs per day.
1.62 million, okay. And that includes new records for both liquids. They hit about 1.18 million barrels a day, and natural gas, touching 2.7 billion cubic feet per day, BCF per day.
Wow.
And that jump you mentioned, the 257,000 BOE per day increase from last year, a lot of that was fueled by strategic acquisitions they closed over the past 12 months or so, plus some solid organic growth too.
Okay, wait. 19% more volume, capital budget flat. That's some serious operational heavy lifting.
Yeah.
Where did that pressure get absorbed? This must be where that big deal, the AOSP swap, fits in.
Absolutely. That's the linchpin.
Tell us about the mechanics of that Albian deal they did with Shell.
Right. So that transaction closed November 1st, right at the start of Q4. And it's definitely the key lever here. CNQ now owns and operates 100% of the Albian oil sands mines and all the reserves that come with them.
Okay, 100% ownership and operatorship.
Yes. And crucially, they also kept an 80% non-operated interest in the downstream pieces, the Scotford Upgrader and the Quest carbon capture facility.
So they control the mine but have partners downstream.
Exactly. Now, the value isn't just the barrels, though that's significant. It immediately adds about 31,000 barrels per day of bitumen production annually. And this is key. It's zero decline production.
Zero decline, meaning they don't need maintenance capital just to keep those barrels flowing.
Precisely. No capital needed to sustain it. But the real leverage, the strategic win, is about integration.
Integration? How so? You mean across their different oil sands operations?
Exactly right. CNQ now has total operational control over both their original Horizon mine and the newly acquired Albion mine. Think about the big expensive gear, haul trucks, dozers, graders.
Yeah, massive stuff.
They can now move that equipment, share parts, standardize maintenance, optimize everything across both sites. That eliminates redundancy, drives down costs, and unlocks, well, potentially huge value through continuous improvement. It's those efficiency gains combined with the zero decline production from Albion that gave management the confidence to actually raise the production guidance for the year.
Without touching the $5.9 billion capital budget.
Without touching it. That's what you call an accretive deal. It pays for itself and then some through savings in efficient production.
Okay, so let me summarize that central insight for you listening. They essentially bought high-quality production that doesn't need constant capital feeding, and that purchase unlocked savings across their existing operations. Then, boom, they raised their full-year production target to between 1,560,000 and 1,580,000 BOEs per day. That really validates the whole efficiency story.
It really does.
So let's zoom in on the assets themselves. If the acquisitions brought the volume, the day-to-day execution must be where the cost leadership comes from. What were the specific operational highlights that show they're running leaner and meaner than others?
Yeah, okay, let's look upstream first because that's where they really shine, setting benchmarks. Take oil sands mining and upgrading utilization was super strong, 104% in the quarter.
104%? How's that even possible?
Well, it means they were running exceptionally reliably, maybe debottlenecking slightly above nameplate capacity, and their operating costs there. Truly industry-leading at CAD $21.29 per barrel of synthetic crude oil, SCO.
21.29. Okay.
Then you look at their thermal in situ ops, that's the steam injection method. Production was solid, over 274,000 barrels a day, and costs actually decreased 2% year over year, dropped down to CAD $10.35 per barrel.
Just over $10 a barrel. Wow.
Yeah, these aren't just good numbers because oil prices were okay.
Yeah.
This shows deliberate, continuous improvement work going on.
And even on the conventional side, usually higher costs, but they found savings there too.
Absolutely. Their conventional primary heavy oil production jumped 14%. And that's largely down to their very successful multilateral drilling program.
Right. Explain that quickly for listeners. Multilaterals.
Sure. Instead of just drilling one horizontal leg from a vertical well, they drill a main well bore and then branch out with multiple horizontal sections like fingers into the reservoir, all from one surface location, one pad.
Maximizes contact with the oil.
Exactly. And because you get more production from a single setup, it's inherently lower cost per barrel.
Yeah.
So by increasing the proportion of this multilateral production, they drove those primary heavy oil operating costs down significantly by 12% to just CAD $16.46 per barrel.
1646. So efficiency engineered right into the drilling plan.
You got it.
And that focus, that efficiency, we saw it translate into huge E&P growth from those acquisitions too, right? North American light crude and NGL surged, what was it, 69% year over year.
Yeah, a massive jump, an extra 74,000 barrels per day compared to last year.
And that came from where exactly?
That reflects the volumes from the liquids-rich Duvernay assets they bought late last year, the light oil from the Palliser Block assets acquired in Q2, and then the liquids-rich Montney assets near Grand Prairie. Those Montney assets alone added about 32,000 BOE per day in Q3.
Okay, got it. A portfolio effect from the deals.
Definitely. And you saw it on the gas side, too. North American natural gas production was up 30%. Again, largely those Duvernay and Montney acquisitions plus good drilling results.
King costs.
Costs went down there as well.
Yeah.
Natural gas operating costs dropped 7% to CAD, $1.14 per McCaf. You see the theme. Every segment is focused on lowering the cost to get the product out.
Consistent cost pressure.
And they're not resting. Looking ahead, they talked about specific disciplined development plans, really focused on maximizing the use of facilities they already have. They're drilling new pads at Primrose using CSS cyclid steam stimulation targeting production in the second half of 2026.
Okay.
They brought new SAGD pads online recently at Jackfish in July and Kirby just in late October. And maybe the key project is the pike tie-in. They drilled 2 pads of pike and they're connecting them back to the existing Jackfish facilities.
Why is that key?
Because it's designed to keep the Jackfish plant running at full capacity well into 2026. First oil from that tie-in is expected in January, then more in Q2. So it's not just drilling for the sake of volume, it's smart drilling to sweat the assets they've already paid for.
Right, filling the pipes. Okay, so we've seen the efficiency on the ground, the value from integrating Albion. Did all that hard work actually hit the bottom line? Let's shift to the financials. Did it translate to dollars and cents?
Oh, absolutely. Robustly. Adjusted funds flow for Q3 came in at approximately $3.9 billion. That supported adjusted net earnings of about $1.8 billion. So strong cash generation underpinning everything else.
And then that cash funds the shareholder returns, which were pretty significant.
Very significant. They returned $1.5 billion directly to shareholders just in Q3. That was mostly dividends, about $1.2 billion, and then another $300 million buying back shares.
So a steady flow of cash back to you, the owner of the stock.
Exactly. And it's not just a one-off good quarter. If you look year to date, up to early November, they'd returned about $6.2 billion to shareholders. But the really remarkable stat is the consistency.
The dividend track record.
Yeah, 25 consecutive years of dividend growth. And not just small, increases at 21% compound annual growth rate over that time. In a sector known for volatility, that kind of reliability is, well, it's highly attractive.
25 years, 21% CAGR. That's impressive. And the balance sheet supports this.
It provides the foundation, yes. They finished the quarter with over $4.3 billion in liquidity. Their debt-to-EBITDA ratio was very comfortable at 0.9 times. Plus, they got a nod from the rating agencies, secured a new long-term investment-grade rating of BBB+ from Fitch during the quarter. Just solidifies that financial standing.
Okay. And that financial strength, it ties into their cash flow allocation policy, right? You mentioned it's quite transparent.
Yeah, and this is really important for you listening to understand. It's a rules-based free cash flow FCF allocation policy. They have a clear target. Once net debt gets down to or below $12 billion, the plan is to return 100% of free cash flow to shareholders.
100%.
100% target. Now, why does this rules-based approach matter so much? It minimizes, management just deciding on a whim. It makes capital decisions predictable, structured. Shareholders get confidence that, okay, regardless of maybe some short-term commodity price swings, that excess cash flow is coming back to them.
So it's a mechanism for reliable long-term wealth creation, essentially. Less guesswork.
Precisely. Less guesswork, more structure.
Okay, that paints a really clear picture of the internal machine.
Hmm.
Let's zoom out again. What does all this operational strength and financial discipline mean in the bigger picture, the broader market context? Do they talk about macro challenges, specifically market access,
Yeah.
egress?
Yeah, they definitely covered egress. The clear message from management is that strong, reliable egress, getting the product to market, is still the single most important factor for the whole basin's stability.
And TMX is helping there?
They confirmed TMX, the pipeline expansion, has already helped stabilize the Western Canadian market significantly.
Okay.
And looking ahead, they're projecting that the light-heavy differential, basically the discount their heavy oil gets compared to benchmark light oil, should stay pretty stable in the CAD $10 to $13 per barrel range.
That's quite tight historically.
It is. And they attribute that to the improved egress picture, plus sustained demand, particularly from Asia. They also mentioned they keep an eye on all new potential pipeline projects, confirming they're watching things like Energy Transfer's proposed South Illinois connector.
Okay, so that's the oil side. What about natural gas? We know AECO pricing, the Alberta benchmark, has been weak. LNG exports must be strategically vital then, right? Especially with all the gas potential they just bought.
Absolutely critical. And this is where their really smart long-term hedging strategy comes into play. They obviously see the near-term weakness in AECO pricing. So what do? They locked in a massive 15-year natural gas supply deal with Cheniere down in the U.S.
15 years. How much volume?
It's for 140,000 MMBtu per day, starting in 2030. But the real genius, as you hinted, is the price linkage.
Ah, it's not tied to North American prices.
No, it's tied to the global Japan-Korea marker JKM. That index reflects the premium prices paid for LNG in Asia, which are typically much higher than North American benchmarks like AECO or Henry Hub.
So it diversifies their price risk completely away from the continent for that chunk of gas.
Exactly. It provides crucial diversification, insulating a good portion of their future gas revenue from potentially weak North American prices. Very forward-thinking move.
Okay, one last area, the regulatory environment. Always a factor. They mentioned dialogue with the new federal government. Sounded somewhat positive.
Yeah, they used the phrase, more positive signs than maybe they'd seen in the past, particularly around the collaborative talks on Pathways Alliance. That's the oil sands producers' decarbonization initiative. So the tone seemed encouraging.
But there was a caveat, wasn't there?
There was an important one. While the engagement itself is positive, they stressed that the crucial details, the mechanics around what they call carbon competitiveness, basically, what specific climate measures will be required, and, critically, how they'll be funded or supported, those details are still, in their words, not well understood.
So more work needed there.
Definitely. They emphasized the need for continued close talks with government to make sure future growth opportunities, which are important for Canada's economy, aren't stifled while they work towards environmental goals. It's a balancing act.
Right. Okay, so let's try and synthesize this whole picture for everyone listening.
Yeah, I mean, the takeaway is that C&Q is running like a highly efficient machine right now. They've got this deliberate, two-pronged approach working really well. First, using smart, accretive acquisitions to drive immediate production growth that doesn't break the bank, hence the 19% volume
Like
jump.
flat capital.
Exactly. And second, maintaining incredibly strict, industry-leading cost control. You see that in the CAD $10 thermal costs, the 21 SEO costs. It's operational discipline combined with strong financial planning. And that translates directly into those predictable rules-based returns for you, this shareholder.
Which brings us to our final provocative thought for you to mull over. Management kept mentioning an upcoming open house event. They promised to give more detail there on the cost savings they expect from fully integrating Albian with Horizon.
Right, getting those synergies quantified.
Exactly. So here's the thought. If CAD $21 per barrel for mining and upgrading is already the best in the industry, what does that next level of operational efficiency even look like? How much lower could those costs possibly go once Albion is fully folded in?
Yeah, what's the next benchmark they're aiming for?
That's the knowledge nugget to chase next. What does peak efficiency truly mean for them?
A good question to keep tracking.
Well, thank you for joining us on this deep dive into C&Q's really remarkable quarter. We definitely encourage you to keep exploring the dynamics here. It's a fascinating space. We'll catch you next time.